Welcome back to Delta Code, Delta Nation. For many companies, I've made that's a lot of Delta diagrams. That is 150 Delta diagrams for Q2. Okay, I will try to hit as many as I can. I've grouped them up by industry. So we'll see like your Disney, Netflix streaming apps. We'll see your social media apps like Snapchat and Pinterest. We'll see your productivity software like HubSpot or Teams. We'll take a look at defense like Palantir, SpaceX, Lockheed Martin, or space technology, Kratos. We'll take a look at big pharma, Pfizer, Moderna, Johnson & Johnson, Jazz, Merck, AstraZeneca, Eli Lilly, Novo Nordisk. We'll take a look at payment and new finance apps like Robinhood, PayPal, Coinbase, Circle. Then we'll look at big boys like Microsoft, Apple, Amazon, Meta, Google, Tesla. Also chips, SK Hynix, AMD, TSM, ASML, Micron, Intel, Qualcomm, ARM, SanDisk, Nokia. Then we'll look at infrastructure plays for AI like AAOI, Nebius, BlackBerry, Lumentum, Corsair, Amcor, and others. We'll take a look at Chevron, ExxonMobil, because gas prices have been up and these boys have been raking in the profits. Other energy like Bloom Energy, Eaton Energy, GE Verona, VRT. We'll also take a look at healthcare like Humana, United Health, and Cigna. We'll take a look at your cars, your Rivians, your Ferraris, your GMs, your Teslas. We'll take a look at finance, Blackstone, Schwab, Morgan Stanley, BlackRock, Wells Fargo, Citi, JP Morgan, Bank of America. We'll also take a look at FedEx, UPS, maybe some food, some Cheesecake Factory, some Chipotle, some Wendy's, some McDonald's, and so on. All right, let's jump into it. I'm just gonna go in from the top and see how many we can get through. So this is Q2. This is Delta diagrams. The way to read a Delta diagram is on the left, we have how does this company make money? All the revenue items. They roll up into a revenue line. The revenue line then gets parsed out on operating expenses and operating profit. In the end, hopefully you're left with some net income, also known as profit, and our earnings per share. In the right side, we have fundamentals. Fundamentals are your fundamental metrics, your market cap. It helps to know, hey, this company makes close to $8 billion per quarter, and they're worth $75 billion. Their current price to earnings, that EPS, is 50. Their forward price to earnings is 27. Their price to earnings growth is 1.3, and their price to sales is about 2.96. So if they were to keep all the profit from their sales, they would make it would take 3 years. Okay, so C is I think a Singaporean company. They have e-commerce, digital services, digital entertainment, sales, goods, and other services. About $8 billion. It is up 10% quarter over quarter. Operating income is 10% higher. Net income is only 5% after taxes. higher, and 3% quarter over quarter, with the earnings per share being up 3%. Looks good. Currently high PE, but it looks like there's expectations and there's solid growth. Tencent. This is one of my favorite Chinese conglomerates. This company is worth $528 billion, as you can see here. The reason I like this company is they are like a hedge fund. They invest in various things. They have their tentacles in everything in China. And they also invest like a VC. They own, I think, 10% of Snapchat. They're all over the place. So this is one of my favorite companies. If I'm ever sitting on a bunch of cash and I feel like I should invest it shouldn't be in cash, this is one of my go-to companies. Not a lot of thinking required because they're so diversified, right? They have a fintech business, they have marketing, they have whatever VAS is. Vast amounts of stuff. So their PE is 15, 4P is 12, PG should be something, maybe it's negative. Price to sales is a bit high. Overall, I like it. 6% growth revenue quarter over quarter, 2% decrease in net income, partially due to these two things, expenses and taxes. Solid investment gains. This is a great one, right? They made $1.6 billion, 500% more because their investments are amazing. Solid company. Okay, next one is Coupang. This is a Amazon of Korea. And now some of these companies, I won't even know what they do. I just made a delta diagram because they reported earnings, but I know most of them. So if I reach one that I am not familiar with, we'll learn about it together. Okay, so Coupang is the Amazon of Korea. Now, they had a 4% growth in revenue, but there were some more expenses than usual, and they paid high income taxes, so their earnings per share was negative. 4P is 50, price to earnings growth is 5.7, price to sales is 0.8. I think this is a good opportunity to start a position at the current valuation. Next, On. This is your shoe brand. One of my favorite shoe brands. 20% growth here, 10% less here. Overall revenue is over $1 billion in Q2, 1% growth, though net income is also 1%, but earnings per share dropped. It's $10 billion company, 32 PE, 4P is 14. Price to earnings growth is really good, and price to sales 2.6. Overall, solid. HUYA, this is your Chinese social media app. We have live streaming, game-related services, and advertising. Revenue is up by 2% to $256 million, and overall net income is up just a bit, but not bad. 4P is 15, price to sales 0.2. I don't know much about this company. I don't use these apps in China, but overall numbers don't look bad. So if you look for Chinese exposure, this is not terrible. Next one, Franco-Nevada. This is a mining company in my state. Gold, down 8%. Now, I don't know if this is because gold prices went down. Silver down 26%. Energy up 20%. PGM and other mining down 30 and 49%. Overall, net income was down 24% and earnings per share down 24%. Price to earnings is 33, forward PE is 25, price to earnings growth is 1, but price to sales is 22. That's really high. If you were looking for gold, there's probably an ETF. This doesn't look terrible, but not great either. AppLovin. Now, this one reported earlier this week or late last week. Lots of interest in this company on social media. They had 4% growth. They made $2 billion in revenue this second quarter, of which 1.27 is profit. This is a 6% growth quarter over quarter, 3.7. Now, market cap of 140 means that the price to earnings is 36, forward is 19. Price to earnings growth is 0.45, but price to sales is 22, which is really high. People seem to really like this company, have high hopes for it. I don't know actually what it does. Makes software. Numbers look all right. It's a little expensive for my liking, but could be a good pick. I don't own any. I've had it before, long time ago, just because I was buying things randomly, but it's all right. If you have this, doesn't look bad. It's pretty solid numbers. Fat green. On to the next one. Trade Desk. I have had this one. I still have this one. The CEO bought like 146 million stock, which is unusual. The numbers actually don't look bad. That's a 61% growth in profit. It's a 4% growth in total revenue. But after they reported, it just got plummeted. It went from, I think, like $20 to $13, where it's at now. P is 19, 4P is 14, price to earnings growth is under 1, and price to sales is 0.8. It's a solid one. I might buy more. Shopify. They had a 13% growth in revenue in Q2. Subscriptions up 7%, merchant solutions up 15%. They had investment gains of $1.2 billion. I don't know what this is. Did they invest in SpaceX? Is this where this came from? I don't know. But if it wasn't for these investment gains, they would only have about 450, of which it would be much smaller. So price to earnings is 141. Forward is 60. Price to earnings growth. These numbers look really bad to me. This is an overpriced, overvalued company. I don't have any. If I had any, I would sell. Procter & Gamble. Fabric, baby, beauty, healthcare, grooming. So it seems like most things either had zero growth or positive growth other than healthcare, which is down 10%. Overall, net income is down 23% quarter over quarter to $3 billion. You have $3 billion in profit, but you're a $333 billion company. Your P is 21, forward is 20. Price to earnings growth 7. Yeah, this doesn't look attractive to me. It might have a dividend that's good, but I won't look at that now. D-Wave. This is your quantum computing. You'll notice a pattern. These quantum computing companies, wow. $3 million of revenue, of which $48 million is a loss, worth $8 billion. I don't know. Price of sales is ridiculous. I made a portfolio short in quantum companies and it's doing amazing. EF, Energy Fuels, UUU, Uranium Fever. Uranium made $25 million, down 30% quarter over quarter. Overall, net loss is $33 million. Worth $3 billion, just losing money. I'm not sold on this uranium fever, so pass. Hard pass. See how right it is? Hard pass. Teradyne. Now this is a good play for robotics. This is in my robotics portfolio. We got semiconductor stuff, product testing. Robotics is $100 million, 10% quarter over quarter. Product testing is 34, and semis are only up 1. Net income is down 6% quarter over quarter. PE is 60, 4P is 30. Solid growth, but PS, price to sales, is pretty high. Maybe on a more of a pullback, this would be a good addition, though I do have high hopes for Robotics. Boston Scientific, also robotics play, down 32% in profit, but all green in the fundamentals. Worth $69 billion, PE of 19, 4 PE of 12.5, price earnings growth 1.2. Not bad. This cardiovascular is 3.6, and MedSurg, surgical probably, medical surgical. All right, yeah, doesn't look bad. 5% growth in revenue. Litigation charges. Let's see, restructuring. Yeah, I guess they amortizationized some stuff. Thinserve. This is a company I wrote an article about. This hit my radar because Michael Burry recommended it. Check out the blog for a full write-up, but we started a position in 45 or 48. It's now 50 something. It's doing well. Great growth, 10% net income. All green fundamentals. Single digit P, even lower, 4P. Great growth. Price to sales, just solid. $5 billion of revenue, worth basically 5 times that forward. So let's go. This is a long-term keeper. Thank you, Mr. Burry, for putting this on my radar. That's all I got to say about this. Read the full write-up on this, why I put it in my portfolio. Visa. Now it says Q3, but this is Q2, but it's fiscal year 2026. So this is just because some companies have a different fiscal calendar than the regular calendar. Now, Visa had $11.5 billion of total revenue. That's a 4% growth quarter over quarter. Worth $690 billion, P32, forward 24, price earnings growth 1.7, and PS 16. It's a solid company, but if I was buying a $500 billion company, I would, or this is almost $700 billion. I think there's better companies at this price that have better growth potential. MasterCard, similar story, pretty much same thing. We got $9 billion in revenue. It's worth $510 billion, $4 billion. Yeah, that is not bad. Cognizant. I have no idea what this company does. Financial services, health sciences, product resources, communication, media technology. $5.5 billion of revenue. Solid fundamentals. P of 12, 4P 9, price earnings growth 1, price sales. This just looks like a solid company. I'll probably have to do a deep dive on this one, see what they do. But this is a good starting point for me because I like what I'm seeing on the fundamentals. Lots of green, profitable. There's some restructuring here that happened. That's probably one-time fee. So next quarter is probably going to be even better. Coca-Cola. Now, Coca-Cola is a Warren Buffett company. $13 billion last quarter. That's a 13% growth. 27p, 25. Yeah, I don't like this. It's probably a nice dividend if you're looking for a dividend stock. Maybe I should include dividend in the fundamentals because sometimes you can't tell, like, why would you own this company? Doesn't seem attractive in the valuation, but perhaps they're just sending you dividends and that's the reason to own. ADP, employer services. Ooh, they're suffering. Down 8%. P25 or 20. About $1 billion of profit, down 28% quarter over quarter. This is for Q4 fiscal year 26. I don't like it. Probably getting chewed up by AI. APH, communications, harsh environment solution, interconnect sensors and systems. PE of 43, 4P of 26, price earnings growth 1, 90% growth in net income, which came from 20% here, 10% here. Not bad. Another one that I'm willing to look at, though the P is pretty high. And yeah, it's a big market cap for just that much profit. Applied Digital had 100% growth in revenue, but the net income is down 11% quarter over quarter because of gains derivatives. Yeah, I don't know. This company doesn't look that great. $8 billion? No thanks. Next, Boeing. Boeing had commercial airplanes sales go up by 28%, defense down 2%, everything else. Standard revenue up 11%. Market cap 175 billion, PE of 114. This is pretty crazy PE. Now, this doesn't tell you everything you need to know. This may be a good example to discuss. Boeing is an enormous company, $175 billion, but it's actually more valuable than that to the US economy. How many airplanes Boeing delivers in any one quarter has a material impact on the GDP of the United States of America, because every plane is made by thousands, maybe millions of parts. And all those parts are made by thousands, tens of thousands of small companies that are making. One's just making the rivet, one's making the door, one's making the seats, one's making the leather for the seats, one's making the bathrooms, one's making the mirrors. You can imagine every piece might be outsourced and then they just assemble it. When Boeing makes a plane and sells it, all those little factories get paid, all those employees get paid. So this is an important company to keep an eye on for the health of the US economy. 11% growth, that's good. But I wouldn't want to invest in this company at 114 PE. No thanks. All right, let's pause here. Maybe not pause. Maybe not pause. Let's keep going. Flex. Flex Integrated Technology Solutions, regulated manufacturing, cloud power infrastructure, solid growth of 6%, 14% net income, 38 billion market cap on 8 billion of revenue. It's a price to sales of 1.36, price earnings growth. This is pretty solid. Willing to look into this one. Let's start a list. What companies are we going to look into more? Get Flex. What's the other one I was looking at? This one. Cognizant. CTSH. All right. I think that was it. Yeah, Boston doesn't look bad. Boston Scientific. Different from Boston Dynamics. All right, where are we now? Flex. Yeah, Flex looks good. 14% growth. As per share. GNRC. Similar. Really high PE. 4P is 17. Solid growth. Let's see. Looks good. Worth looking into further. GNRC. My nose is very itchy. Stellantis. First half, 3% growth, 100, almost 100 billion. Wait, what? These numbers don't make sense. Are we using different currency? I'm gonna say this, there's something off here. Pause. And back to our regularly scheduled programming. Stellantis makes cars, and this is Q1 and Q2 put together. I don't know why we did that. Why did I do that? Just failure of imagination. Doesn't look that great. Doesn't look that bad. I don't know. I'll look into it some more. We'll put this one in undecided. Next one, Cameco, uranium, fuels, down 5%. Doesn't look good. Fundamentals quite red. Pass. Elf Beauty. This one was highlighted also by Dr. Michael Burry as a potential lipstick recession play. 7% total revenue growth. Net income up. Earnings per share 1. Let's say if it's 2 versus 3. Pretty high PE. No, I don't own this one and I will not at these prices. But seems interesting enough to take a look at. Elf Beauty. TTM Technologies. Data Center Network up 34%. Total revenue up 19%. Net income up 66%. P is pretty high. 4P obviously gets dropped. Price to earnings growth. I don't know. This one, I would have to go read the Q2 shareholders letter and see what the guidance was. Maybe I'll start including that in the fundamentals, some dividends and guidance for next quarter. But as of this, looks all right, but expensive. Figma revenue grew 11%. Obviously, because net income is negative, all the fundamentals go out the window. This is possibly SaaS apocalypse going to get eaten by Cloud Code company. I don't own any and I'm not touching it, but revenue grew 11%. DraftKings down 12%. I think DraftKings and sports betting is going to lose to prediction markets. Why would you bet on DraftKings? I actually don't even know how DraftKings works. I've never bet on there, but I'm guessing you're probably betting house odds, unlike prediction market where you're betting against other people. And yeah, their World Cup, I think prediction markets took all the revenue, as you can see by Coinbase and Robinhood growth in prediction markets. Polymarket and Kalshi are just eating sports betting alive. I wouldn't touch any of this. Invest in Polymarket instead. Airbnb, revenue grew 35%. Net income up. Market cap 91 billion. P is high, but honestly looks pretty good. I don't have any Airbnb, but I'll consider it. I'll put it on maybe. It's going on my maybe list. Look into. The thing is, when you have a maybe list, you have to compare it to the obvious buys list. And we'll get those. We'll get those midway through. Some of the memory stocks are so obviously a buy that all these maybes don't stand a chance at the moment. Rigetti. This is another quantum computing, I think. Systems, components, research, fat loss. Like, how do you bring in $5 million of revenue but lose 50? That's Ouch. Yeah, no. No. All I gotta say is no. This was in the quantum short portfolio. Did great shorting it. Red Cat. Also, no. It's terrible. You have 20 million in revenue, but you're losing 35. No. Now, all these no's could become yes, but I'm not going to bet on a turnaround until I have a compelling reason. And you can always, once they're turning around, jump on board. Sure, you may get less of a return, but it's safer. And investing is about managing risk. So Red Cat is a no. MP Materials. This is important for onshoring. This is one of the strategic companies that the government invested in, but looks atrocious to me. I would stay away from it. 4P is 51. Price to sales 24. I don't know. Do we really need those magnets? Oklo. Oklo is a... What is Oklo again? Power generation, quantum, something. Looks bad. Looks really, really bad. I don't want it. No, thank you. Zillow. Now, 150p drops to 11. Price earnings growth 0.3. There's some growth here. Redfin got acquired. There's only Zillow. It's your Redfin and whoever acquired Redfin, I forget. But those are your two. Whenever housing turns back around, this will be a stock to own, and this one might be betting on the future. It's part of a duopoly, in my opinion, for retail buyers. I have some Zillow. I might consider adding more here, but again, it's hard to the 4P. There's some expectations. I don't know. I would not be opposed to adding this at the current prices to a portfolio. The PE is pretty crazy. What is that? Almost 800 million, 8 billion. That's a 10x for 1 quarter. Yeah, honestly, this is not a bad buy. Teams Atlassian, subscriptions down 1%. Somehow we made money. More money. It's all right. Not crazy about it. Pass. HubSpot. 4% growth. 33. This is similar to Salesforce. This is one of your, I think like Salesforce and HubSpot are the two you could choose from. Almost $1 billion worth 10. So it's going to make 4 billion in revenue. Market cap is 10. Yeah, I would want to see it become more profitable. Maybe cut some of these expenses. But a solid company. Own some. Not adding here, but we'll keep holding. Pinterest. This is also a one I've had for a long time. Thought about it recently because of the PayPal offered acquisition from Stripe. Remember when PayPal offered to buy Pinterest, Pinterest refused. I don't know, 60 or 80 billion market cap offer, and now it's 13. Growth looks good. Revenue looks good. I want them to be more profitable. You got to cut this R&D and sales. What are you selling? Come on. They need to control their spending a little better. That's solid revenue. Cut this in half, right? Cut this billion of spending in half, and you'll have you'll have 2 billion of growth of profit a year. That's totally reasonable. So any day now, Pinterest might actually do the smart thing. Snapchat, similar thing. You just got to cut the spending, like the R&D, all this bullshit. Have yourself $2 billion of profit each year. Both Pinterest and Snapchat are honestly a good takeover play, and just gut it. got it to efficiency. Match, here we go, about the same amount of money, but there's actually some profit left over because they're not crazy with their OpEx. Fundamentals, solid green. This is a good, even now, buy. I've had this for a long time. Solid company. Is doing what Snapchat and Pinterest should. Berkshire Hathaway, 9% revenue growth, little bit of everything. Freight, insurance, they made $22 billion from insurance premiums. At the end, $25 billion on $1 trillion. Presume that's 100. It's 10x. Yeah. Not bad. Not bad. Though growth is selling insurance. What do you want? I think they're deploying now. They're buying more Google. So there might be some growth. They're sitting on a lot of cash. They're just making money from interest right here. 16 billion a quarter, doing nothing, just sitting on money. HIMS. This is also a popular on investment Twitter. Solid growth. It took a dive. I think there was a lawsuit about data privacy or something, but growth looks nice. I want to see profit here somewhere. Obviously, their marketing has to be. Why is G&A up 50%? That's unacceptable. Yeah, I don't like doesn't look good. I would hope having more revenue selling peptides or something might be a big thing for them, but fundamentals don't look good. They're not keeping much money, not returning much value to shareholders. Upwork, however, $200 billion in revenue, worth $1 billion. Fundamentals look phenomenal. And this company is, I think, like 25% shorted. This might be a good short squeeze. I've written short squeeze theses for these before. Upwork was one of them. Carvana was the one that actually worked out great. Any day now, Upwork will work out. Datadog, atrocious. Great that to see growth on $1 billion of revenue of 11%, but P 600, forward is 80. Fundamentals are just terrible. I don't care how much you grow. This is not justified. The price to earnings growth is not justifying any of this. Yeah, I would double this. I've had this before when it was much cheaper, but at these prices, this is insane. This is not justified. Next, Kratos. Are we investing in defense of defense? 24% growth in revenue. P is 300. That's all I got to say. No, thank you. Seems all right. It seems like a fine company, but at a much cheaper price. 500 at 2. But the cost. Yeah. Maybe more war is good for this company. So if you're expecting more war. Rocket Lab. This is if SpaceX is, if you want to budget SpaceX, here you go. Also not profitable. Great. Yeah. No, thank you. But if you want to invest in space. Space Cats. Lockheed Martin. Now here's a military defense contractor that actually makes money, that has all green fundamentals, that's profitable, 20 billion revenue, market cap 134. I am not mad at these numbers at all. Look at this. Nice, solid. Walk away with $2 billion, $8 billion by the end of the year, right? If you just do this every quarter, expecting to do better, more war, more missiles, let's go. So if you want to bet on more war, this is the one. Palantir, also more war, but this is not the one. This is not the one. The price to earnings growth is 138. So they made $2 billion, right? They're worth $389. They made $20 billion. They're worth 134, right? What their total revenue is, this company's entire is profit. Palantir hopes to be this company one day. So you can just buy this company that is this company today. Sorry to get a little heated there. I don't like Palantir. I think it's a dumb company. I'm glad you're growing, but this is not justified. Hope they fail. SpaceX. Now this one, again, not justified here. Elon is saying nonsense. There might be a lawsuit. They don't deliver. AI, according to Elon, is going to be pretty much all the gravy here, because they're building data centers and they can rent them out. They acquired Cursor so they can start doing stuff that Claude does. They rented out their compute to Anthropic for Claude, so they're going to have some AI revenue coming in. It went public at $135. It went up to $220. Then it dropped to $108 recently. Now it's $150. So this is called price discovery. As shares are hitting the market, there's unlocks happening. So it's going to go up and down. I'm not touching it until 6 months from IPO, until everybody's had a chance to dump their shares. Fly, another aerospace company that's losing money, but not terribly overpriced. Only $4 billion on $100 million of revenue. Disney, $25 billion of revenue, of which 2.64 is profit. That's 17% growth. Solid fundamentals. P16, forward 13, PG at 1. Solid company. You know what? Despite things being down here and here, this picked up the slack. Pretty nice. Netflix, also not bad fundamentals. You got 12 billion of revenue. You're keeping 3.4 as profit. Technology, marketing, general. Not bad. I picked some up at 69. I think it's 75 now. AMC, this one had some hype because of major blockbusters that are coming out in Q3 and Q4. We had Odyssey hit in Q3, and we're going to have Dune come in Q4. Also, Doomsday is a Marvel movie with Doctor Doom that's going to come on December 18th. How do I know that? Don't ask me questions. Don't ask. Ask no questions, hear no lies. AMC, solid growth, 53%. They got to keep nothing, so no profit. Just a lot of expenses. Yeah, I don't know. Monday, this is your software for work stuff. I don't like this company. I've used their software. I think they're going to get replaced by AI. There's nothing innovative at this company. I wouldn't touch it. It's trash. Fundamentals look okay, but I think you could just have a $20 cloud code subscription that will do everything this company does. I don't know how much they pay per seat, but sell it. Uber also bought this at the same time I bought Netflix, also $69 per share. It is 138 billion, P blah, blah. Just solid growth, 7%. Great everything. There is fear that Waymo is going to do autonomous rides without Uber, Robotaxi from Tesla. These are all competitions that don't have drivers, so they can have a more competitive price than Uber. But what people fail to grasp is Uber is in so many countries. They have so many drivers. It's going to be a long time before autonomous, full self-driving cars are allowed on all the streets. I know that Robotaxi from Tesla is only in Austin in a very small radius. Waymo, it's pretty much San Francisco, I think, maybe Vegas. So Uber is everywhere. Anywhere you go in the world, you got Uber. So I don't think they're going to get displaced anytime soon. And there's nothing stopping Uber from having driverless cars too. And they already have distribution. So Uber. I bought the dip. Reddit. This one is an interesting one because they're getting advertising revenue from and data licensing for large language models. I don't like Reddit. It's overvalued and I hate this website. It's totally useless. So maybe I'm a boomer, but I think it's a stupid website that I find unusable. So if AI is going to use it as a source, I think it's just being hacked by people just posting threads for their hacking large language models. So no thanks. Pass. ServiceNow. This is not bad as far as forward stuff, but P is high right now. 6% growth. Yeah, I don't know. No thanks. Pass. 3 billion revenue. Fundamentals look okay, but there's better options. Paychecks. Here we go. This is a better option. Though it had 11% decline in revenue. That's pretty expensive. But solid. Solid key piece. 420 net income. This is one of my favorites. Novo. Makers of Ozempic. PE is 10. At a 20% decline in Ozempic, basically sales, because there's other GLP-1s that are picking up the slack and coming on the market. Undervalued, in my opinion. I have both shares and some 2028 options. Eli Lilly, expected to start selling retatrutide, a GLP-3, most advanced weight loss drug, sometime late next year. Pretty high PE, 4P. If you just compare Eli Lilly to Novo, you see that the fundamentals look better for Novo, basically the price you're paying. Now, Lilly has great pipeline. Their sales are doing great, 16% growth, but still overvalued. I have both. So you don't have to pick one or the other. You can bet on both. I think GLP-1s and weight loss drugs are going to be huge. Peptides are huge. Own both. Why not? AstraZeneca, not bad. 256 market cap, 2.5 billion profit on 15 billion revenue. Just solid. I have no strong feelings either way. If you want to add it to a basket of Pharma, seems like a fine pick. I did write a Merck blog earlier this week because they got FDA approved for a cholesterol drug using the Cas9 therapy. So I think that's going to be good, though this is their big money maker that expires in a year or so. The biggest revenue maker is going to lose its patent. So that's going to be some replacement needs. But I think Merck is a solid company that deserves a place in a pharma portfolio. AbbVie, also solid. Really high P right now, though it's expected to drop. Not bad. A little expensive for me. But if the growth continues, this 13% like that, it can grow into it. Jazz, solid growth. 13% on 1.2 billion, only worth 16 billion. Solid fundamentals. I'm not familiar with any of these things, any of these drugs. If you are, let me know. But Jazz looks solid. Again, I think having a pharma sleeve is really prudent for any portfolio construction because Doesn't matter what the oil prices are. Doesn't matter what AI does. AI can only help, honestly, at this point, for big pharma and biotech. Biotech and big pharma are different. Biotech is drug discovery, usually smaller companies, and then these guys come in and buy. Sometimes they have deals where they are financing some of the stuff. But yeah, I think having a pharma and biotech sleeve in a portfolio is prudent portfolio construction. If you want to see my biotech portfolio, you can find it on Savvy Trader. It's one of the best performing portfolios, largely because it's not correlated with other assets. Moderna, they got FDA approved for a mRNA influenza vaccine. I don't think that's going to be a big hit, personally, given all the Fauci stuff that's happening. People are going to be hesitant. Yeah. Though, mRNA technology, as I'm told by my doctor, is huge, groundbreaking, possibly cancer curative. So, not a lot of revenue. I want to see, obviously, this might bump up with their new vaccine. But as of now, I don't have any Moderna, nor plan to add any. Pfizer, $15 billion in revenue, grew at 4%. Solid fundamentals. I would want to see some better profit over here. What happened? Other deductions. Not sure what this was. We might have to dig into that, but this is a solid company. Not bad. J&J, little expensive at the moment. 25 billion, 600 market cap. Fundamentals don't look great. But again, if you just want to diversify, not a terrible company to have in your portfolio. All right, moving on to Fintech. Square, ticker symbol XYZ, also known as the company Block. Are they Block now? Are they Square? I don't know. Revenue grew 9% to 6.6 billion. They're only worth 5 billion. They got 300 of profit. Bitcoin made them almost $2 billion. Honestly, this is not bad. As far as Fintech, hold and or add, start position. SoFi, 11% growth on 1.2 billion, worth 20. P's a little high, though they're growing. Hold or add if you already have some. If you don't have any, start a position. I would start a position. Oh, that's interesting. The little square symbol, and they have a square symbol. Interesting. You'll notice that fintech, financial institutions, usually have blue color because it conveys trust. So if I would hold or add. Solid, everything solid. 11% growth. Circle, 15 billion. Maybe, I don't know. I would just buy Coinbase. Coinbase is, let's see, stablecoin, they got $300 million, right? That's basically this from here. 300 million got paid to Coinbase right here. So you don't need to buy this. You can just buy this at 43 billion and you're getting half of their revenue. That's pure profit right here. Crypto losses were really the bastard here. Obviously, crypto price is down. It was still positive EBITDA. Still one of my biggest positions. Look at this. Corporate interest, blockchain rewards, institutional transactions, other subs. And now we have stocks. It's probably going to roll up into here. We have derivatives. We have prediction markets. Once they break $100 million, they'll break them out as their own revenue item. All of those will break $100 million of their own revenue. So wait and see. Now, Robinhood, what's interesting here is prediction markets made more money than stocks or crypto for Robinhood Q2, largely driven by the World Cup betting, sports betting. I bought more Robinhood. I thought there was a dip. I pulled the trigger because I like what they're doing. I don't like their app, but I like their CEO. They're doing interesting stuff. Revenue growth 23%, while Coinbase lost 14%, right? So they made up with more stocks and prediction markets. Coinbase also has prediction markets and stocks now and derivatives. So it's a matter of time of them marketing that and getting people to use it and pay for it. PayPal went up on the offer from Stripe to acquire at $62 a share. It's about $60 a share now, $58, $59. That was not a serious offer because why would they? They should have offered double the value. If they offered maybe $100 a share instead of $60, PayPal board would need to consider it. I mean, this is a solid company. Single-digit PE for a money printing machine like this. What? You make $1 billion each quarter. You're worth 50. Takes you 10 years to just make all your money back. Buy the company. Mercado Libre. This is your Amazon of South America. They're investing heavily right now. So PE looks a little high, but this is a solid investment. Hold and or add or start a position. Not selling this one. Samsung. This is one of my favorite companies. First of all, it's worth only $1 trillion. Okay? Hold that thought. Just remember, it's worth $1.1 trillion. It's worth less than SpaceX. And yet, it made $114 billion in revenue. Okay? Of that, almost half is just pure profit. $47 billion of profit. Look at these fundamentals. For a company this big to just be printing money, obviously memory is killing it. $80 billion in just memory. The memory in your iPhone is made by Samsung. The screen on your iPhone is made by Samsung. The battery. Is it the battery? Memory, screen. Maybe the battery. A lot of components of your iPhone are made by Samsung. That's why I think it's a better company. And it's just white labeling an iPhone. You just put an Apple sticker on it and sell it to you at a markup. Why? Why would you do that? Why would you buy an iPhone? Ew. Anyways, buy Samsung. This is one of the prettiest delta diagrams you'll ever see. Look how beautiful this is. Single-digit forward PE. 0.4 price earnings growth. Look at this profit. Wow. If we spend an hour on this one diagram, it'll be worth it to know what a good, profitable company looks like. Compare this to all the ones we covered before here, before this one. Okay. Other 78 we looked at before that one. Even this one, that's worth 3 times more, but makes less profit and less revenue. Should this be worth 3 times more than that other one we just looked at? Huh? Should it be worth? Just going to go back and forth until you realize one of these is better. Still, $35 billion, not bad. PE is 23, forward is 20. Price to sale is 9. Here's price to sale is 1.5. 4P is 4. 4. Microsoft, not bad. but I'm buying Samsung. Amazon, $62 billion on 2.5 trillion. Other income. Anthropic. Is this from making for Anthropic value? 200 billion of revenue, 11% growth. Maybe 27 billion was pure stuff, and then whatever this is, Anthropic. Again, Samsung better. Not bad. Amazon, I got it under 200, but not bad here. I would hold. Apple. Similar, right? Similar to Samsung, right? 100, right? Samsung was 114, a little more, but that's neither here or there. And it's worth, Samsung's worth 1.7. Apple's worth 5 trillion. P is 40. Terrible. Price of sales 10. And they only got to keep 30 billion. I don't know. To my Apple fanboys, but I'm not a fan. Why buy Apple when you can buy Samsung? Meta. This one, I can get with. Look at these beautiful fundamentals. P of 20, forward P of 16. They're spending a lot of money on AI, but they can rent that AI out and make the money back. So this is also Samsung level obvious buy. 1.5 trillion, printing money on 60 billion of revenue. Google. Now, little deceptive. The reason they got 100 billion bump here, this is SpaceX investment, because SpaceX went public and Google owns like 10% of SpaceX or something. They got 100 billion markup of their income. But they had 100 billion of revenue, of which 40 was actual income. Little hard to dissect all this, but a solid one. I would get in this order: Samsung, Meta, Google, if I had to buy 3 of the ones covered. This one, I'm not touching with a 5-yard stick. All great and dandy, except what? You only made $1 billion, but you're worth trillions? That doesn't look right. Samsung, it's worth more than Samsung, but Samsung made $60 billion, 60 times more profit, made 5 times more revenue. What is this? SK Hynix. Here's a good one. Samsung, then SK Hynix. $62 billion in net income. Not even a trillion. Worth not even a trillion. Making way more money than Microsoft, than Apple. Hey, how much money did Apple make? Apple made 30 billion. It's worth 5 trillion. This is one of my new favorites. Been adding heavily to my portfolio. Yeah, I don't know what to say. This is the number 2 memory manufacturer in the world. Okay? Samsung, number 1. SK Hynix, number 2. Micron, number 3. It's beautiful. Look at this. If you're ever wondering what a good company should look like, an obvious good investment. Fat green income, fat green profit. AMD. Okay. SK Hynix makes $50 billion of revenue. Wait, how did it end up? Oh, they have some other income here. Anyways, ended up with $62 billion. AMD makes $11 billion and is worth almost the same. Make sense? I'll take SK Hynix. Thank you. Bye. Solid growth. 13%. Data centers grew at 16. Everything's growing. Beautiful. But way overvalued. 170p. No, thank you. TSM. Solid. Just solid. Doesn't matter who wins from the chippies. They need TSM to make it. $2 trillion on $40 billion of revenue. Solid. ASML. Little overvalued, but growing. TSM and ASML are monopolies. So when you have an opportunity to buy a monopoly, you should. Micron. Solid. Beautiful. Very similar to SK Hynix. Little overvalued, relatively, right? Keep that in mind. You want to buy a memory company, there's a better option. Intel. Let's spend some time on Micron because Micron is a popular one. Cloud memory grew 78%, core data center 103%, mobile clients 49%, automotive 71%. Basically, just everybody needs more memory. 4P single digit. Price earnings growth 0 points, like insane. They're just growing so fast. Intel, similar to AMD in a way. Growing, that's great, but also terrible, overpriced. Why get this when you can get SK Hynix or Samsung? Seagate, similar story. Memory, hard drives, overpriced relative to Samsung, SK Hynix. Qualcomm, not bad. We got 10 billion of revenue. We're worth 140 billion. We got to keep 2.5 billion or 2 billion. 17p 14. Not bad. This is the chip that's in all your phones. Qualcomm Snapdragon. MSCI, 40 billion on less than a billion. Little overpriced in my opinion. Pass. ARM, $239 billion market cap, P 265, forward P 74, price earnings growth 235, and price to sales 48. Overvalued in my opinion. They got to keep 270. Yeah, I don't know. Pass. When you have Samsung, why would you? SanDisk, also very popular memory play. Single digit forward P, currently little high, but expected to be sold out just like Micron and SK Hynix and Samsung. Given your options, again, SK Hynix and Samsung are better value at the moment, though you can hardly go wrong with any of them. Solid 91% growth in earnings per share. This one had a wild ride because of Koreans. It went up to $2,500 and then it dropped to $800 and now it's like $800, $900. So the 4P is just telling you this is going to grow into it. So not opposed to starting it. Nokia. Now we're going into AI adjacent. Obviously memory already has been, and AMD and all the hyperscalers. They're the ones requiring all this AI. Nokia is one of these companies that is making infrastructure for AIs. Overpriced, but looks like it's going to grow into it based on the forward P. Lam Research, overpriced in my opinion. 6.72 billion revenue, 15% growth quarter over quarter. They get to keep 2.2 as profit, but overpriced in my opinion based on the fundamentals. Cerebras, growth of 100% in revenue did not translate to profit. Market cap 36 billion on 200 million revenue. They must be expecting some crazy growth, but yeah, if it keeps growing like this, I guess it compounds at some point, but looks overpriced to me. CoreWeave, 50 billion on 2 billion in revenue. I guess all this infrastructure spend is, I don't know if that's per quarter and they make money later on, but there's clear place for AI here, in my opinion. SMCI Supermicro, 11 billion of revenue. They got to keep 20 billion market cap. P16, 4P8. This is pretty solid. I would rather take this over the previous couple. Supermicro. IBM, $17 billion, 8% growth, 200 million market cap. They got to keep 2 billion. Forward P is 19. P is 19. Forward is 16. Not bad. Not bad for IBM. Dropped after they announced earnings or prior to their earnings. Amcor. This is the company that tests and packages chips, your iPhones and everything. 6 billion in revenue, worth 21 billion. I have this. I've had it for a long time. I'm expecting this to grow more, but it doesn't seem to be growing as fast as I expected. So nice to see net income. Corsair. This was an insider's buying play. P is insane, but rest of fundamentals are great. I bought it at $4 to $6 based on insiders just buying like crazy. They're making money off of their deals with memory makers, I guess. LITE, Lumentum. Optics is the new memory at your own peril. 152 PE. I don't know. Maybe in retrospect this will be obvious, but doesn't look good now. Similar here. 10 billion and 200 billion revenue loss. Again, optics play might be good in retrospect. Growth is there. I want to see more aggressive growth. But what's here? 24%, 27%. AI infrastructure, pretty expensive. It's growing, but there's better places to park your money, in my opinion. BlackBerry. Atrocious. No, thank you. $152 million of revenue, worth $6 billion, P 120. This looks like a dumpster fire. Texas Instruments, your TI 8381 calculator, hard at work, 5 billion revenue, 250 market cap, P42 forward. Again, better semiconductor and chips. Caterpillar. Now this is infrastructure play. To build all these data centers and onshore manufacturing, you need to build factories, you need to build stuff, and obviously Caterpillar has grown like crazy in the last couple of years. 18% in the last quarter revenue growth. 400 billion. Overpriced in my opinion, but like a critical infrastructure company. 3M, 87 billion on 6.5 billion revenue, 87 market cap. 4P is good. Fundamentals a little, again, every company I look at here so far, we've done 110, 40 more to go. In 1 hour. Good job, us. I compare to your Meta, your Samsung, your SK Hynix, your SanDisks, right? As good as it looks, does it look better than those companies? Chevron, 41% growth in revenue, 460% growth in profit. This is just gouging because of war. Windfall profiteering right here. This is wartime profiteering at its finest. If you're going to own oil companies, I guess this one and this one, seeing crazy growth because of wartime. War with Iran equals good for oil companies. Somebody go watch that scene from Good Will Hunting where he's talking about working for the CIA and some oil company. Halliburton, speaking of wartime profiteering, fundamentally very green. Revenue up 6%, profit up 16%. Green across the board. If you need a wartime profiteer, Lockheed Martin and Halliburton. Alcoa, aluminum grew at 31% quarter over quarter. I don't know if that's normal. Commodity businesses are not my forte, but looks good. FPS, first person shooter, frames per second. Forgent. Power, good. We need more power. Growing. Interesting. Could grow into it. Keep an eye on it. Bloom. $1 billion of revenue, $47 billion of market cap. Growing like gangbusters, 42%. Yeah, this might be justified here, the price earnings growth for probably an insane PE. Eaton Energy. Now this one is solid. This is solid. You got many product lines. It's worth 0.7 to sales. You get to keep $2 billion and $70 billion. Green across the board. And this one has a nice dividend, I think. So keep it, buy it, hold it. GE Verona. This one has a high PE because they are the company to make gas turbines, which all the AI data centers will use to connect their power, because connecting to the grid is impossible. We don't have enough juice. It's a subsidiary of GE, I think, or breakout, but here's GE. 13 billion, 360, doesn't look great. Not buying it, probably has a dividend. VRT, this is your cooling for data centers. Would have been nice to have bought this before the PE was so crazy. It's doubled, tripled in a year. So at these prices, I think the boat has sailed. I would sell or hold. Moving on to healthcare providers. Cigna Healthcare, up 5%. 76 billion on 71 billion of revenue. Green across the board. Nice to know that health insurance makes such a good profit. Great system we have. United Healthcare, 384 billion market cap on 112 billion of revenue. No growth, but green fundamentals going forward. Right? Once CEO got shot, they cooled off for a couple of quarters, and now they're back at it. Humana, 40 billion of revenue, 40 billion market cap. Not as fun in the fundamentals as the previous two, right? This one looks the best, followed by this one, but that one. Intuitive Surgical, I think this might be a good robotics play. I am in the process of writing a blog for it. So, looks solid. More to come. Stay tuned. Don't forget to subscribe. Subscribe here, Delta Code Alpha on YouTube or Substack, Delta Code. Anytime. Any day now. I'll wait. Why don't I wait? AutoNation, $7 billion of revenue. Green across the board. Pretty solid. 6% growth. If you like AutoNation, looks good. GM, $48 billion of revenue. P is 41. Forward is nice and low. I don't know. I'm not a fan of GM, but doesn't look bad. Where do they make their money from? Automotive sales, financing. $2 billion in financing. Wow. Rivian, hot pile of trash on fire. Terrible. Atrocious. Ferrari, pretty amazing. 70 billion, 2 billion of sales. Fundamentals are terrible, but crazy. You can sell 100 cars and be this profitable. AT&T, this is a solid addition to a portfolio. This is a beautiful delta diagram. Look at all these revenue items. Not growing, but profitable, and there's a solid dividend with this one, if I remember. Fundamentals look great. Fine to add this to a portfolio. Moving on to financials. Blackstone. Revenue growth 39%. 89% growth in profit. I love this. Just tells you how finances work. Solid, not bad, not great. Schwab, much better. You got 7 billion, 170 billion. You got 5, 150. So I would take Schwab, better fundamentals. All things being equal, get more profit at the end. Morgan Stanley, obviously they were the underwriter for SpaceX, so they had a bigger quarter. And it's probably might even show up in Q3. Not all of it. Great fundamentals. BlackRock, not as good. Not as good as Morgan Stanley, to be fair. But solid. 2 billion. Wells Fargo, solid fundamentals. Can't believe these guys still exist, and they do, and they're printing money. Citi, nice fundamentals, printing money. JP Morgan, the 800-pound gorilla, printing money. This is Facebook level of profit. Pretty nice. Bank of America, also solid. All the financials, they just make money. They're in the business of money. They print money. United Airlines, 38 billion on 800 million of profit. Fundamentals look okay, but I don't think airlines are a good business. I wouldn't touch it. Abbott, this should have been with the pharmaceuticals. They're better ones, right? There's Novo. Not bad. Deserves a place in a biotech pharma portfolio. State Street, very nice. Fundamentals, solid growth across the board. Again, financials are so good. Progressive Insurance, so good. People just give you money, you have free profit. Deny them claims. Bending Spoons, this is a recent IPO. I think we're done. We done? No, we're not. FedEx, not great growth, but why buy this when you can buy AT&T, for example, or actually UPS looks similar. 622 billion, 25. I think I have to keep 1.6, 77. I didn't know UPS was bigger than FedEx. Interesting. Oh, FedEx actually looks better, but Deckers, something you can compare to our OnCloud. Should have put them together. Or on company. Not bad. Your Uggs, your Hokas, your Tivas. Let's get into food. We're almost done. What are we at? 5 more and we're done. Cheesecake Factory, did you know that they are worth $4.4 billion? They sold $1 billion of fun stuff, and not bad. Chipotle, 400 million of profit on 43 billion. I don't know. Fundamentals say no bueno. Wendy's is actually not bad. Relatively. I haven't been to Wendy's in ages. I used to like their nuggets. But honestly better than Chipotle. Though Chipotle probably has a better moat. McDonald's, almost 200 billion or 200 billion of profit. Not terrible, but I'm not excited about it. This is the company I'm excited about. And that's it, folks. Let's see. Put Deckers up here with OnCloud. There we go. Put the shoes together. Maybe we'll get Nike over here at some point whenever they report. Yeah, of all the companies we covered, the 150 companies, obviously your Thinserve, Visa, MasterCard, print money, your hyperscalers, right? Your Netflix and Uber make money. Your hyperscalers, your pharmaceuticals, Moderna, Novo, they make money. SK Hynix, Memories, SanDisk, Samsung, print money. Meta looks great. And then oil companies, Chevron, ExxonMobil, print money. Banks, print money. Investment institutions, print money. And then you have your up-and-comers like optics, your infrastructures for AI that are very unprofitable, but that people are betting on. I prefer just betting on these fat green, just printing money. Meta should be even fatter, but they're investing a lot into buying AI. Apple is not doing that, but to each his own. Then you got some apps, Match.com, Uber, Netflix, that are solid, profitable companies. They have great growth. Possible turnarounds. You have your Snapchat and Pinterest that if they just cut costs, they could be much more profitable and worth a look. Your quantum computers are more speculative than optics that are probably going to be the next thing in the AI train. And then pharmaceuticals are just uncorrelated to the rest of the market. They don't care what interest rates are. They don't care what is happening with oil. If they got a vaccine for cancer, you're going to pay them whatever. And they're working on it. It's a good business. All right, folks. That was it. If I may ask you to subscribe, share all these companies. Let me know if you would like access to this archive. Type in Delta code archive in the comments if you would like access to this. I want to see how many people actually, like a gallery maybe? Maybe you want to click on this and be like, oh, wow, this is the fundamentals. This is the summary. Here's the previous quarter. Here's this quarter. Did I do this twice? Silly Apple. Here's Airbnb. Have a nice summary of what happened. Did I cover Adobe? Did I report yet? Oh, Adobe looks great. That's a nice fat profit. Anywho, that's it, folks. I've cracked the code in investing. Delta code is where I hand you the keys.